Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining us. This is our Multifamily 0 to 1 online meetup. So this is episode 14. We'll have Juan introduce himself in a minute.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
So my name is Marcelo Cazini, and my background is in IT and software development. And I'm a local CCIM member here. I completed all the CCIM designation training. And I'm a multifamily investor, and I also own and operate my own commercial real estate. And before multifamily, I was also involved with single family fix and flips. Claudia and Martin.
Hello, everybody. This is Claudia Rubio, and I am a commercial real estate investor. We are based out of Houston, and I'm also a real estate professional, and I have a degree in architecture. I was born in Colombia, South America, and that's where my background in asset management comes from, managing our own assets there. And I hold a National Apartment Association certification that's called Independent Rental Owner Professional Certification. And Martin, you want to go ahead?
Sure. I'm an IT security consultant. I've been doing this for almost 25 years. Most of those years were with my own consulting firm. Since we're together 16 years ago, we've had different businesses together, most of them related to real estate. And we started multifamily here in the US a couple years ago. So now we're invested in around 800 units as limited or general partners. And we just finished our first syndication here in Houston in December. So we're brand new in that subject. That's it.
Perfect. Thanks, Martin. Juan, would you like to introduce yourself?
Sure. Thank you. So first of all, I want to say thank you guys for the opportunity. I really do appreciate that. It is my pleasure to be here as a guest and just to be able to provide any information that I can based on my experiences, that I had, through my career in commercial real estate and multifamily specifically. So my entity is Genwealth Capital Group. So we oversee 700 units in under asset management. I'm also an equity partner and/or general partner in 1,500 units. And so, a little bit about me. I got started in single family houses. And, from there, I switched over to multifamily in 2016, early part of 2016. And this was through a 32 units. And then from there, I was able to, partner up on a couple of deals and invest passively because I wanted to expand my knowledge and just, learn from the other guys and just kind of look behind the scenes, behind the curtain, so to speak. And, just learn as much as I could from those guys and, eventually took it to where, we're able to also do our own deals and that type of thing. So yeah, just a high level view of my background there.
And you just mentioned earlier that you started with single families in real estate, right? And you switched over to multifamily. So what was about multifamily that interested you and made you switch over and maybe never look back into single families?
Yeah, very good question. So for me, it was simple and it was my aha moment. And that was in multifamily, you have multiple doors, right? So I had a couple of single family homes, and on my last single family home, I had a really good tenant, but then he ended up leaving. He was a military, he was in the military, so he had a move, and I had trouble leasing back up, and I was doing marketing, I was doing all the things that I could possibly do, but it took me a little bit longer to get it back and leased up. And so then I realized that, hey, you know what? I'm the one that's paying for, you know, the mortgage. I'm paying for utilities. I'm paying for everything here, and it's coming out of pocket, right? And then I just thought about it. I was like, well, you know, what if I had a 10 unit, you know, and then, you know, I had that one tenant leave. I'm still 9% occupied, and over here in this single family home, I'm 0% occupied, right? 100% vacant. And so it just that simple reason was the trigger for me to go from single family to multifamily. And, you know, at that point I was like, you know what, I'm not looking at single family anymore. I'm just going to look at multifamily, and I'm not going to look back. Now, you know, since then, you know, I still get, you know, single family homes, you know, pitched to me and those type of things. I'll take a look, but it's not really, that's not my first thing. And really my biggest focus is multifamily. So long story short, you know, is because of the scalability that you can have in the multifamily space. You know, not just the number of doors, but there's so many different things, you know, financing, it's a big one. You know, you can go on and on and on. Right. But yeah, that was my trigger moment, you know, the reason why I got into multifamily. Yes.
Yes, thanks, Juan. And you just touched on a very important point about scalability. And from then on, you can scale on the amount of benefits about multifamily. I guess we're going to talk about it later. But yeah. Gets even better, even more than just scalability, but it gets way better than that.
Yeah, another reason, and I guess I'm kind of going into comparison of single family and multifamily right here, but another reason was that I didn't have to, you know, jump around in multiple different locations. I didn't have multiple different, you know, insurance policies and multiple different mortgages. You know, it was one mortgage, and just to kind of be clear, it was a 32 unit, so it was one mortgage, one location, and you get that instant scalability, right? And not to mention, you know, the way that they're valued as well, you know, in the single family space is on comps, and in the multifamily space, it's on NOI, which is the net operating income. And that was another good piece that I realized. I was like, well, you know, this is crazy how you can increase the value that much, that quickly. And so it was just another good reason, right? So it was just a bunch of different reasons on top of each other, right? That I was like, okay, this makes too much sense, you know? So yeah, it was all those combined.
Actually, I appreciate that comparison between single family and multifamily, because we have a lot of people here that maybe are in that stage where they have their single families and they want to jump in, and that comparison makes them see the big picture of the multifamily industry.
Yeah. One thing that we're not touching on, and we haven't touched on yet, but it's the time, right? And so there's something we can talk about, you know, much deeper, but you know, one of the things that I asked myself was, you know, what is the reason why I got into real estate in the first place, right? Is it because I want to, you know, get my hands dirty and just, you know, go to location and fix things? Or do I want to increase my flexibility and my time and spend more time with my family, that type of thing, right? And I think for the majority of us, you know, we want that flexibility and time. And so, you know, if you are doing single family and you have a few single family homes, you're not going to get that. You can have your W-2 job and you can have a few single family homes here to the side, but guess what? They're going to be calling you because you're not at that scale, right, yet. So they're going to be calling you for this or for that, for leasing, for repairs, one thing after another. And so in the multifamily space, depending on the size, right? Because if you're too small, then it's going to be the same thing. But depending on the size, you can have a full-time staff. And so then it allows you to have more flexibility in your time. So that's one of the things that I ask myself, you know, do I really want to spend so much time here or do I want more flexibility? And that flexibility is super important. And it still continues to be super important for me. You know, being that I have three boys and a wife and, you know, just got to be there for them, you know? So I think it's just, you know, like I said, you know, that's just, you know, the comparison, single family versus multifamily there, right? A few different points there.
Right.
Yeah. And I think additional to that, if you're looking to make a business out of this, I think that also complements the answer in which you're going to be able to have with maybe 2-3 deals that you have, you're going to be able to start building your own business. If you're going to do that from the single family space, you're going to have to at least have 30-40 houses to be able to make it into a business. That's a great point. So moving on to the 0 to 1 portion of it. I know your first deal was an independently owned property. You didn't have any partners. It was not a syndication. So we'll try to focus the questions a little bit towards your first syndication, but all the experiences from multifamily add up. So when you were doing that transition from single family to multifamily, some people think, okay, the first one I'm gonna try a 5-plex or a 10-plex. I'm just gonna treat it like 10 houses, things like that. But once you start getting bigger, and you mentioned you have to work about towards NOI, things like that, you need to get education, right? So what was that path for you to get educated on how multifamily worked when you were looking for that larger deal, like let's say your first syndication?
Yeah, very good point. So I'll go back a little bit on the 32 unit. I didn't have any, there's a bunch of groups out there right now, right? There's a lot of very solid groups out there. But I hadn't joined a group at that time. So simply, man, I just read some books, listened to a few podcasts, just try to learn from other guys that are already in the business. And then I was like, okay, enough is enough. I got to take action, right? And that's ultimately where you're going to learn the most, right? So I took action, and I gained some experience on that 32 unit. Now, if we're speaking of the syndication side, that the progression to that syndication was me working in with other guys, as a KP, as a partner of their deal, and I was able to learn from them, and also by passively investing in other guys' deals as well. Combination of both, it helped me to learn. So a lot of the things, one thing I would say also real quick is you never stop learning, right? You can have a bunch of different deals, and there's always going to be something that you hadn't run into before, right? But on the educational side, it was, yes, I've joined a group, and I think a lot of us here on this call are affiliated with the group. It's based out of Dallas, Brad Summer's group. And so, through that group, I was able to meet with a lot of different people that are very, very good people that I was able to partner with on the syndication side. But yes, you are correct. On the educational side, you have to have some kind of education, because it really does minimize any kind of, mistakes, any major mistakes that you can make. There's still going to be some small mistakes that you're going to make. That's just part of it. You have to realize that there will be some, and that just comes with being in the space. But it really does minimize the timeline that it'll take you from going from here to here. That 0 to 1, like we're here for. But it's crucial. It's very crucial. So I think it's very important to do that, right? So I would say for me, it was a bunch of books, it was a bunch of podcasts, it was a bunch of networking, like this one, for example. I mean, this is a solid one right here, because we're all introducing ourselves and just communicating and asking questions, and being part of a group like Brad Summer. I think it's very, very important. If you want to scale and you want to get into to larger deals, I think it's very important for sure.
Awesome. Yeah, I think one great point you did there was taking action, right? Most of these meetups and in person, we give a lot of focus to education and get people to understand this is not something that you can learn from one day to the next. You need to get education. But I think it's also important to make notice that it's just as important as education is to take action, right? You have to jump in the water. You don't need to be a professional swimmer. You'll figure out
Hey, Martin, I think you muted yourself.
Sorry. So I think that the strategy would be to be able to figure out when you have enough information, because you cannot start from zero, but you cannot wait until you know everything. So just to know when you're ready to jump, and then you're going to be learning on the way. Yeah,
I agree 100%. You're never going to know everything. And that's part of it. Like I said, there's always going to be something that you don't feel good about. You're always going to have those butterflies. That doesn't change. When we're closing deals, I get those butterflies, and I'm thinking to myself, am I making the right decision here? Is this right? There's always one piece of it that doesn't feel 100% right. Right? Even if you're doing a brand new development deal, did you overpay for the land? Is your performance way too high? Is it overly optimistic? There's so many different things, right? You're getting a great deal. You think you're getting a great deal at $30,000 a door, but it's like in the worst location you can buy, right? So there's always something that doesn't feel good about something. But you have to be willing to take that first step and that action. Without that, then education, it really means nothing. Like, honestly, it means nothing. You have to be willing to pull the trigger.
Mhm.
Yeah, awesome. So when you felt you were ready, you had enough information, enough education, and you wanted to jump in the water, what was your basic strategy? Like, what markets did you try to pursue, and how long did it take you to find that first deal for syndication?
The first syndication that we did was in Dallas, and so for me, I wanted to find something local. So I'm based here in Houston, so you can say that's not local. To me, it's still kind of local because I can leave at 7 o'clock and be there by 10 o'clock. And so I wanted to find something that was local in one of the three major markets, or you could call Austin, one of the four major markets, but Austin pricing is just way too high, and the cap rates are way too compressed. So I don't really look at Austin, but I look at San Antonio, Dallas, Fort Worth, and Houston. And I wanted to find something, like I said, in a market that was business friendly, landlord friendly, and we have it here, man. Texas is a strong market. We're continuing to have population growth and job growth, and why look all the way in Florida or something like that, right? I think we have enough inventory here, and enough possibilities here. So that's why I went with Texas.
Right.
Awesome.
Thank you.
And how was your first deal structured? Your first syndicated deal? I mean, how many co-sponsors you had? How many units? What kind of class? Did you focus on a particular demographics? So tell us about that first syndication.
Yeah, and so that first one, there was, what is it, 4 or 5 of us, I think, in that deal. So we had a couple of KPs, and there's three of us that are really focusing on the asset management side of things. We weren't necessarily looking for a particular type of demographic, I would say. Being that it was the first deal, you open it up more, right? You're opening up to more possibilities, right? As you go in a little further in your career, you try to zone it back in a little bit, right? So you're going in, you have to be a little bit more open, because the truth of the matter is it's very competitive, and if you want the best deals that are out there, I mean, those are usually won by a particular set of guys that are already experienced. But yeah, our first deal that was syndicated was in Dallas, as I said, and it was 184 units. You can call it a C plus, B minus type of deal. It was in South Dallas, and it's a good little deal for us. Yes.
Was it a competitive situation? Did you get into best and finals, or did you just win the LOI right away, or how was the
So
process?
that deal was brought to us off market, actually, and so we actually had a relationship with the seller, and so there was we had a good relationship with the broker as well, and the broker, he was sending us a few different deals, and then he brought us that deal as well. He said, hey, I have this deal. The seller is not 100%. He hasn't made up his mind if he wants to sell yet, but I'm building this relationship with him, and we may be able to get this deal from him for the right price. And so we looked at it. The financials made sense, and we went forward with it. And so this deal was a deal that we assumed. It was a loan assumption, and we also got a supplemental. And so for those of you guys that don't know what a supplemental is, it's basically like a second loan. You have the first lien, and then this is like a second lien. And usually it's with the same lender. I don't think there's really any cases where it's a different lender, but I think in most cases it's the same lender. And so what that does is it allows you to get higher leverage, and so the numbers are able to make sense, and that's how we are able to close on that deal. Yes.
All right. And so, given where we are on the market now, a lot of folks here that they're trying to start and get their first syndication, what would you offer as the best advice for someone getting started now?
Yeah, so there's a lot of different things that we can talk about. I mean, we talked about education. That's super important. You're never going to stop learning, right? We're still learning, all the time. And I know that, 20 years down the road, I'm still going to be learning. That's not, anything with that. But you have to know that you're going to be making mistakes. But you have to be willing to take that action. Again, I've already talked about that, but I think it's the most important piece of it, right? Learn as much as you can, surround yourself with the right people that are already in the business, ask questions, be willing to take action. That's ultimately what is going to decide people that are successful in this business versus people that are not, right? So you have to be willing to take action and know that mistakes will come, but be around the right people, and if there's deals out there that you want to, tackle, it's better to team up and get 50% of a deal than 100% of nothing, right? So I think it's very important where, we tend to want to get our own deal, and usually that means that it's a smaller deal. But if you can scale up a little bit bigger, and even if it's 2 or 3 or 4 or 5 people in one deal, as long as you guys have a good chemistry and the skill sets match, then I think that's the right way to go, because it reduces your risk. You're able to learn a whole lot, and you're able to take that experience and take it to the next deal. So, it's a bunch of little different pieces of advice that I would say, but I think, that's what I would say for sure.
Yeah, I think the teaming up, I think you bring an excellent point there, because it's hard to be good at everything, right? So when you join the parts that you're good at, so if you're good at underwriting, maybe somebody else is good at finding the deal, maybe somebody else is good at raising the money. So I think that's where it makes the path maybe perhaps a little bit easier, is finding that skill set that complements what you do good at, and then find somebody else who can add to the pie there. Right.
That's super important. Yes. For a lot of you that are looking for that first deal, really it's relationship, right? If you can't work well with that person, then it really defeats the purpose of going further, right? So find somebody that you can really work with, and it doesn't have to be one person. It could be 2 or 3 people, but find also people that have a complementary skill set. If you're good at underwriting, like Marcelo said, find somebody that's good at broker relationships, or somebody that's good at raising capital, or somebody that's local to the market. 1 plus 1 has to equal 3. It can't equal 2, right? So you got to make sure that whoever you partner up with is going to take you that much faster, that much further and faster, right? So that's what I would say for sure.
And Clayton, I think you had a question, didn't you?
Maybe. I don't really know how to fit it in, but I was somewhere in that stream of consciousness. I was gonna question about, in this kind of like shifting market or new market dynamic that we have post coronavirus, and obviously all the financial assistance programs and different requirements that the agencies are putting into place. I think that it's not just about finding a deal is different now. I think finding a deal is different now, but getting a deal to close and funding a deal is very different now. And so, I know that, you guys just closed a deal right before this whole thing went down. What are some thoughts that you have about how, like, if you were going to kind of re-enter, looking for another deal now post-COVID, what are your thoughts around things like, not so much just finding a deal, but, how that dynamic has shifted between, getting a deal to close and funding it? I see some really, really drastic changes in how the lenders are evaluating, evaluating new loans, and just, I think that that's probably harder now in this new environment than finding a deal, right? Because with challenges come opportunity, and I think there's owner operators that probably are going to use this changing dynamic to look to sell or to get out from underneath properties that maybe they've mismanaged, or maybe they had poor funding choices up front, and now they're stressed out. And so there's going to be, I feel like there's going to be a lot of opportunities to find deals, but I think this whole dynamic about how you fund them, how you work with lenders to I'm not talking about the capital raise, but I'm talking about specifically with like the agency and funding. How have you seen that change, or in your social circle with other deal sponsors? What have you heard about that, about the changes in the lending environment?
That's a very good question, Clayton. Thank you for that. So it definitely has changed, right? Whereas before, we didn't have the biggest change, I would say, is a couple different ones. Is the leverage Whereas before, we were anywhere from 70 to 80%, right, leverage. And so now, it's more in that 65 to 75%, right? Depending on the market, depending on the deal, the quality of the deal, depending on the sponsorship experience, and depending on if you have other deals in that same market, and also depending on if you've done a Freddie Mac deal before with them, or a Fannie deal before with them. So it's a lot of different things, but yeah, you're right. The other big change has been the reserves, right? So they're wanting to have those reserves up front, and so that can really break a deal. So what I've seen other colleagues do as a result of this is that they are, if for example they had a $3 million capex budget, you're not going to do all $3 million anyways up front, right? So it's not like you're going to close the deal and then do all $3 million. And so if there's say $1 million that they had to put it aside up front for reserves, you usually can get it back between 1 year or 3 years. So you can take care of all the capex items that you had addressed or that you wanted to take care of up front. And then once that 1 year, the 3 years comes by, then you have the rest of that capex. So, but ultimately what that does is it does change your underwriting on that front. One thing that we're also doing, us and other guys are doing, is we're not really having that rent growth for year one when we're underwriting new deals. So it's pretty much a flat rent growth. And so on top of that, it's a total income of zero, right? Zero increase, I would say. So from the T12 to year one, it's a total increase of 0%, right? That's what we're trying to keep it at. And so what that does ultimately to the deals is, we have to, offer a lower price for it to make sense for us. And the sellers, they have to be willing to know that, hey, we're in the same environment. Another thing I would add to that is, there's a lot of argument that you can go back and forth with the sellers. A lot of the sellers are saying that, they're still collecting a good amount, even, similar to like pre-COVID. And I think a lot of this is because of the stimulus package and the unemployment, right? So the unemployment, you're getting the extra $600 a week. I think that what that's doing is really kind of inflating the numbers, so to speak. And so even though we're still collecting the similar numbers, we're not really going to see the bigger impact, I think, until later on in the year. And so, that's, come August, September, whenever the unemployment it's supposed to go out, like in July, right now we're at 40 million people of, unemployment. And so a lot of these jobs, and this is just my opinion, I'm not speaking, this is not what I know for sure, but my opinion is that a lot of these jobs are not going to come back, right? At least not initially. So what does that mean, for everybody out there? That means that, there's going to be a lot of unemployment still, right? So it's I think that, we have to, it's kind of a wait and see approach. Once we get into Q3, Q4, then we'll start to know what's really happening. Maybe even Q1 of 2021. And if there are going to be some opportunities, I think that it's going to be a short window of opportunity, and you have to be willing to jump at it quickly. That's just my opinion, right? So, I'm wrong plenty of times. I could be wrong, here again, but that's just my opinion, right? And so we don't know. We may say that, hey, the worst is behind us, but I think that everything's been kept afloat because of the unemployment and those stimulus packages, those care packages that the government just kind of dropped off. We don't know if those care packages are going to be there still, the next couple of months.
Yeah, and I think
for sure. And I think that
sorry, Keita, go ahead.
Sorry about that. No, I think that things are still very much in flux, right? We're constantly changing. So while, on one hand, we don't know what's going to happen with future stimulus and financial support for, to bolster, the shock of the unemployment increase. But I think also, hopefully, knock on wood, over the next quarter or two, we'll see, maybe some people getting back to work and the economy kind of recovering a little bit. So, it certainly is a whole nother aspect. The change in the, coming off of a long-term kind of market high to now this new dynamic, I think we're coming out of this on the other side. We'll be in a different phase of the market. But right now, because everything's changing, there's so much uncertainty, it's easy to just sit back and say, we'll wait and see what happens. I think, where there's going to be, real opportunity is the people that say, you know what, I'm gonna, put my diligence into, doing all the research, checking all the boxes, and taking action, before everything settles out. That's where I think that's where the big opportunity is going to be, is taking advantage of this changing market.
That's a very good point. And for us, just to tell you what we're doing, I mean, we're still looking at deals all the time. We're just not aggressively, going after them. If something, makes sense, and we'll look at it further, but we're not in a rush to make a deal just for the sake of doing a deal. Right. The other thing that I've seen from other experienced guys is that, back in 2008, which was the last recession, we didn't get to the lowest in pricing until 2 or 3 years later, right? So what some of these guys are saying is, don't catch a falling knife, right? So that's another argument for another day. But some of these guys are saying, hey, be patient. What you're seeing right now, it's just the beginning. Come 2021, 2022, that's when the opportunities are going to start to arise. So it just if you see other guys doing deals, it's okay. Be patient. Keep educating yourself. Try to be as ready as you can. And then once we're 2021, 2022, that's when the real opportunities will be around. And so that's what I've seen from some guys, right? But really for us, we're continuing to stay actively looking, but not aggressively trying to put something together, right? If that makes sense.
Yeah.
That's a great analogy, by the way. Don't try to catch a falling knife.
Yeah, I was gonna add on all those variables that are changing week to week that we have to keep an eye on, and we don't know what's gonna happen in the next couple months. For example, we're looking right now very closely at expenses on utilities, right? We were looking at collections in April and May, but the actual expenses on utilities for March and April, when people started staying home, those are only gonna come up in June and July. So we won't know how affected, how our utilities got affected until probably the next few weeks, and then we'll know if expenses really rocketed up or if they stayed kind of close. So it's a moving target. Yeah. Cool. I think. Yeah, go ahead.
Well, I just want to add real quick. I know that you want to get to your next point, but real quick, another thing that's not really showing in the data that's out there is how long it took you to collect, right? So, we see a lot of guys are saying, hey, I'm at the same point that I was, pre-COVID, I'm at 96, 97% collections, but how long did it take you to collect, right? And so, for us, it's taking us a little bit longer to collect, right? So whereas before we're collecting within the first week or two, now it's taking us, week 3, week 4 to get to that same percentage in collections. So that's another thing to really think about, and it doesn't show, because at the end of the month, all you're showing is, hey, we collected this much compared to this other month, and it's the same thing. We're doing the same, but really you're not. You are in a sense, but you're not, because it's taking that much longer. So what does that mean? It could be that the tenants are struggling, or it could be the simple fact that we're not really charging any late fees. So it could be a combination of both. I don't know, but that's one of the things that at least we're experiencing. So it's just something to keep in mind as well.
Yeah, we're tracking collections day to day, and we keep a graph of every single day, and we see, like you said, we had in May, at the beginning of May, we had a promotion. If they paid before the 1st, they would get into a raffle with like a $50 discount or something like that, and you could see how collections were sooner, right? So that's very important to track. Yeah, I wanted to give the opportunity to Manish. He has a question, so if you want to unmute yourself and go ahead, Manish.
Yeah, thank you, Claudia and Martin. Can you hear me?
Yeah.
Yes.
Yeah.
Okay. Hey, Juan, thanks for coming. Just a quick question. So you mentioned that buyers are not, the sellers are not ready to lower down their price, because they're saying like their T3 is almost same like the pre-COVID months, and they're having the same NOI, right? So do you think like it's going forward, it is going to be a norm, or seller or buyer maybe pushing, like if you can, in the PSA, if you can have guarantee of 6 months or next 9 months or maybe 1 year that now after the closing, the new buyer is going to get the same rent?
That's a very good question, right? I think that definitely the terms have become more flexible, and more positive towards the buyer, right? And so I don't know about a whole year or 6 months. Maybe they can guarantee a few months. I have actually seen that where one of the colleagues had a guarantee where the seller said, if the NOI changes after we close, then I don't know what the exact terms were, but there was going to be some kind of settlement there, right? And it was like in the contract and agreed to. But I will say that a lot of the terms have become more favorable towards the buyer, because sellers are in the same, they're in the same business. They understand what's going on, right? And so, to be able to make a deal happen, I think they have to be a little bit more flexible. I've seen a lot, some of my colleagues as well. They're not going in with hard money. They're also they're having financing contingencies, those type of things. So I think slowly it has become more favorable. I wouldn't say it's a buyer's market, 100%, but I think it has become more favorable for the buyers, at least from our experience.
Thanks, Juan.
Hope that helped. I don't really answer the question 100%, but I think ultimately it's just something that has to be negotiated, with and it's on a case by case basis.
Yeah. No, that's a good insight. Thank you.
So Juan, one of the important skills for...
Can't find you. I don't know where you're at. Oh, there you are.
Sorry, yes, I got kicked out and came back in. But one of the important skill sets for a new syndicator is underwriting deals and perhaps looking into a lot of deals until they find the right deal, right? So do you have any recommendation in terms of how would you as you see a lot of deals, maybe not right now, but as you get a lot of deals from broker, how do you quickly analyze them? How do you and then what makes you go to the next level of analysis, and what kind of analysis you look? What are some opportunities in terms of increasing revenue, decreasing expenses? So can you talk through your underwriting and deal analysis process?
Yeah, sure. Another very good question. So, for us, we have a set criteria that we have to stick with, right? So, and I can kind of go through that real quick. It's Texas or Arizona, and we're I said earlier Texas, but we've expanded to Arizona. We're in Phoenix, so either and it's got to be a major metro, right? So if they're sending me a deal that's in Oklahoma, that's automatically pass, because it could be a great deal, but then you're kind of expanding. You're not sticking to your criteria, right? Because I can go into development, I can go into self-storage, I can go to mobile home parks. I can do all that all day long, right? Those are good too, right? And the same thing could be said in multifamily, right? So you have to have your criteria and stick with it, right? And so the other thing is we look for deals that are 150 units and above, right? And so we stick with that. Deals that are B and T class, we stick with that. If it's 60s vintage, I wouldn't say that we pass automatically, but we try to stick with 70s and above, right? That just psychologically is just a number that we like better. But 70s and above, we try to stay away from like chiller and boiler properties. Although we have one, we own one, right? They just tend to have a little bit more maintenance required. So those are like from the physical and geographical standpoint, those are some of the things that we look at. Now, once you're starting to dig a little bit deeper into the property, then we're looking at crime rates, right? If it's a submarket where you're having a lot of crime, then you want to pass, right? Because then you're not buying it in an area that's not really going to help you down the road, 5 years down the road, right? But on the other side, if you're buying it in a property in an area that's gentrifying, it's having a lot of growth, then that's a positive, right? As far as the property itself, the financials, I guess if you want to go into deeper like that, I wouldn't say there's one thing that we do exactly. We always, every time we see a deal, and as long as it passes all the other criteria, then we look a little bit deeper into it. One thing that I would say that's something that I use automatically is the median income. This is just my rule of thumb, right? It's nothing set in stone, but the median income, if it's almost on a 1-to-1 ratio with the price per door, I would definitely take a look at that, right? So if it's a median income of 50,000 and the price per door is about 50,000, then that usually, not always, but usually it'll indicate, for me at least, that, hey, this deal might make sense, right? So that's just something that I try to look at the 1-to-1 ratio. But yeah, you can go into deeper and deeper, but those are some of the high level things that we look at and take it from there.
No, that's good. I hadn't heard about the 1-to-1 ratio, about the median income and the price per door. So that do you find that to be a good KPI for selecting deals?
Yeah, for us, it has been. For us, when we look at that, there usually is opportunity. But again, that doesn't mean that every deal that you look at is gonna be great. But that's usually one of the indicators that we look at. And if it's not 1-to-1, if it's close enough, say the median income is 50 and you're at 75 a door, then you're still within that range. But if the median income is 50 and you're looking to pay 175, then you might be stretching there quite a bit.
Thanks. Those are great pieces of advice, because the underwriting skills are critical in this syndication business. But to wrap up a little bit our portion of 0 to 1, I just want to ask you a question. With the experience you have today, what things you would have done differently now?
So, I mean, really, this sounds kind of cliche, but I definitely would have got started sooner, right? That's one thing for sure. Like, I got my start in 2016. I actually wanted to get started, before that. I was looking, it wasn't necessarily multifamily, but I was looking at single family, back, as soon as the crash happened, but it was all mental. It was all up here. It's not for me. It's not for me. And I wish I would have gotten started sooner, but one thing I would definitely change is just getting started sooner. I mean, that's just as simple as that. Because, you can look 10 years down the road and you'll be glad that you got started because you had that, 10 years of experience, right? And if you don't get started now, then you're just kind of kicking the can down the road and you're not really doing much if you're interested and you really want to do this, right? So I think it is very important to get started, but be smart about it as well. Don't just get into a deal just because, you want to get into a deal. And you see that across, with a lot of passive investors. Yes, you have that eagerness to want to invest in in a deal, to have that experience, from a passive investment standpoint, but at the same time, try to gain some experience by analyzing a bunch of deals like that. Whenever you do see one, then that, hey, this is a good deal for me to invest in, right? So I would say just don't rush into deals as a passive investor. And if you're looking to do your own deals, same thing, right? Don't rush into it. Try to build a team, build good relationships, because there's no I in team. And this business is definitely about that TEAM 100%. So you have a strong team, then you can do some great things.
Okay, awesome. Thank you. So moving on to after the one, once you landed that first syndication and you said, okay, I'm successful. I have a deal that I was able to syndicate, raise the money, put the team together, all of these. Can you tell us like a really good, maybe, I don't know if you have any, a really good story and a really bad kind of horror story from that first deal or any of your subsequent deals?
Yeah, that's a very good question. So I wouldn't say that we had like any horror stories. Just like on that second deal, it was a deal in, excuse me, it was a deal in Phoenix, Arizona. And so where we bought that deal, we knew that it was a little bit more hairy. And so it was a deal that we had to go in there and re-tenant, pretty much everybody, right? So it took us a little bit longer to get it to the point where we want to get it to. We believe we're at that point now. We're not a year into it. We're about 8-9 months into it as we speak. But it did take us 8-9 months to get to this point, right? But it is kind of scary whenever you're you're stabilized when you close on a deal, and then you have to go through that whole re-tenanting process, and then you're like all of a sudden you're in the 80s because you evicted a bunch of people, and so it's something that's it is scary as a sponsor. It's scary for our passive investors, but you have to just trust the process and just know that just follow the business plan, right? So I always say that's if you haven't gone through that, it's challenging and it can be scary, but once you're back stabilized and it's like, hey, that was the right thing to do. That's just a necessary part of the business plan. So I guess that's what I would say. Yeah.
Awesome. Cool. So just getting ready to wrap up, I would say, do you have any specific resource that you would recommend anyone trying to get to their first deal? It could be a book or a tool, software, portal, or even like a personal practice that you would recommend that work for you?
Or a good podcast, if you know anybody that's really good at it.
Yeah.
Yeah, there's a bunch of good podcasts out there. I personally like the Old Capital podcast. Those guys are solid over there. And it's one that I listen to, like, every time there's a new one that comes out, I'm like, all right, let's hit play.
Have they interviewed Kiyosaki?
I don't think so. I don't think so. Yeah. I think he's next on the list, right? And so I think that's a very good one, but there's a bunch of good ones out there. But I would say I learned a lot through Bigger Pockets. So I don't know if you guys have heard of that platform, but they're solid. I've been a member since, 2014, 2015. I don't remember when, but that's how I was able to learn a lot. There's a bunch of people there that are just willing to give out, a bunch of free information. If you go on there and you're, just ask any question, you'll be amazed by how many people just go in there and respond, boom, 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 boom. And it's like, you're getting a bunch of different answers. Usually it's like similar answers, and it's just a, wealth of knowledge. So I'm still a member today. And so that was just a platform where I got started on and was able to learn a lot. But as far as books, one of my favorite ones, it was one of my early ones, and multifamily specifically, is Multifamily Millions by David Lindow. And then the other one is Emerging Real Estate Markets, also by David Lindow. And those were my go-to books whenever I first started to learn about the multifamily space. I think those are worth their weight in gold for sure. So if you guys haven't read those, then pick those up. They're worth it for sure. And then from there, just to have that mindset in business, the cash flow quadrant. That's one of those cliche type of books that you can put alongside with Rich Dad Poor Dad, but it just kind of helps you realize that which side of the quadrant that you want to be on and you need to focus on. So I think that's a fantastic book, and is one of the books that I recommend a lot. One of the books that I really like about business in general is it's kind of dry. So that's one thing, just a warning for everybody. It's kind of dry. Is the E-Myth Revisited by Michael Gerber, I think is the author. It's a very good book. So if you want to get into the multifamily space, like I said at the very beginning, understand what it is that you want to do in the space. Understand why you want to get into it. If you want to, be a passive investor, it's 100% good, 100% fine. If you want to grow as a sponsor, then don't do it as a hobby. Treat it as a business. That's one thing I would say. If you treat it as a hobby, then you're doing a disservice to your passive investors. If you're working full time and then you have a deal or two, I think that it's good, but ultimately you need to make that transition into doing it full time. So what that means is treat it as a business from the beginning, and try to get to that point where you can do it full time is what I would say. But that book, E-Myth Revisited, it talks about how to treat it as a business, work on the business, not in the business type of thing. But like I said earlier, it is kind of dry. So just fair warning, but it is good. So, but yeah, I can go on and on because I love reading books, and I can give you a whole library. Yeah, I can give you a whole library of books for sure.
You've been a great guest. I wish we had another hour, so we'll probably have to ask you back and bring you back for another episode. Yeah. Go ahead.
Yeah, it would be my pleasure. It would be my pleasure for sure.
We do have a question from Amanda that I want to make sure we talk a little bit. Is what are your thoughts about Houston market and moving forward and the dependence with oil? Do you have any thoughts?
Yeah. So if you look at the, based on what economists say, and you can take that with a grain of salt, some people will really trust what economists say. Other people are like, just another guy just giving his opinion. Right. But, based on what a lot of the guys have said, we're going to be in an upward swing according to what these guys are saying. I think that personally, I'm bullish on the Houston market. I think a lot of people don't give it enough credit. Yes, it's depends on oil, but within the oil and gas sector, which makes up about 40%. There's renewable energy, there's solar energy. I mean, there's oil. There's a bunch of different types of oil and gas and energy in general. And we're also much more diversified than we were in prior cycles. So, some of the biggest things I look at in the Houston market is just a job growth, which, we're still going strong. It's the fourth largest city. It's not the fourth largest city for on accident, and, that alone, should tell you something. So I think it's a strong market. People don't like, they're not bullish on the Houston market, and I would say that's better for us, right? Because we'll continue to hopefully find some deals. But I personally think it's a good market. So, I wouldn't look here if I wouldn't think it was. That's just my personal opinion, right?
Our next meeting, June 17th, and then we're back on July 1st. So, and if you miss a meeting, I'm hoping everybody's already signed up on our website, multifamily021.com. But in there on the front page, you have a link to our YouTube channel. We always record maybe a week or two after the meeting is done. We'll post it in there, so you can find some recordings there in case there was some piece of information that you didn't take as much notes today, but you want to review. This will be posted there in a couple of weeks. And with that, Juan, I just want to thank you again for joining us. Is that the best point of contact from people to reach out to you?
Yes, it is. People want to reach out to me via email. I'm happy to, have a call, meet in person, a Zoom call, however you guys want to do it. I'm more than happy to give any bits of advice that I can to help you guys. Then I'm all for that. If you want to reach out to me on social media as well, feel free to send me a friend request or a connection request at the Juan Vargas. And so, I appreciate, Claudia, Martin, and Marcelo. Thank you so much for having me. I really do appreciate it. And thank you everybody for listening to me as well. And thank you for your time.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.